What happens if you have a loss on a property and you die with a loss and transfer that asset to an heir? Interesting, huh? That's what we're going to talk about here today. It's going to be a follow-up to our talk we had 2 days ago about when you die with a capital gain and it transitions tax-free because of step up in basis. What happens if you have a loss? So your basis is actually higher than the net value when you die. We're going to talk about that. So don't forget to subscribe, my friends, right down below. And also don't forget to hit thumbs up or comments too. So let's talk about this. So remember, we're going to bring back Sharon, old Sharon from Illinois. In this case, I want to just revisit the gain concept. I think it's important. So she asked about her house, all right? So she asked about a house, and we're just throwing numbers up there. She said she bought right before the market crash. $250,000 is what she bought it for. It did drop and has come back since, and now it's worth $300,000. So she has a $50,000 gain. All right, so we know if she were to sell this house, now this is a house. It could be a mutual fund. It could be a stock. It could be anything. The same concept applies. We know that if she were to sell this, she would have a $50,000 gain. I got to find a place to put my PVC pipe. She would have a $50,000 gain if she sold that. Now, for a home, that's not subject to any capital gain tax because you have $250,000 of tax-free capital gains upon the sale of a property, as long as it's your owner-occupied property, your principal residence, essentially. So if she sold that, it would be free and clear of charge of any tax while she's alive. Now, if it was not a house, say it was a mutual fund, and she sold it, she'd pay roughly 15%, depending on her tax bracket, but most likely 15% tax on that. So that'd be what, $7,500 she'd pay. All right, so that's if she lives. Now, if she dies, say 2018 is actually her date of death, and she dies, and now she named as through her will or through a TOD, a transfer on death, or even her home. It doesn't matter. If she named Janie as her heir, Janie's going to inherit this whole thing completely tax-free. Regardless if it's a house, regardless if it's a mutual fund, she's going to inherit the entirety of this account, which includes her initial $250,000 basis. $250,000 basis plus $50,000 gain, Janie's getting the entirety of it tax-free. No tax whatsoever because of the step-up in basis rules. Does not matter if it's a house, it doesn't matter if it's a mutual fund, doesn't matter if it's a stock, doesn't matter if it's a baseball card collection. As long as there is an evaluation or an appraisal, essentially, of the purchase price and the sale price, that's all that matters. So if there's a gain and Janie inherits it, there's no tax. Now, this is everything that's outside of an IRA or a tax-deferred or annuity account. Everything. If it's in an IRA, an annuity, or tax-deferred account, this is not, we're not talking about that. That's here. This will be taxable to Janie on the very first dollar. So just remember, an IRA is not applicable here. But any kind of property, it is. And that includes mutual funds or financial assets. All right. So let's keep going here because I want to show you what happens when we have a loss. All right. So now, let's erase this. And we're going to change out from a gain to a loss because this is actually important. And I think it's easy to talk about gains, but it's harder to talk about losses. All right, so she bought again in 2007, and actually this is the real world scenario. She said now it's only worth $200,000 because she bought the market high for real estate, and now she purchased $250,000, and now it's worth $200,000 in 2018. So she has a capital loss in her portfolio, in her balance sheet, if you will. That's a loss. That's not an asset. It could be an asset. I'll share with you here in just a second. All right, so she has a capital loss. She paid for $250,000, it's worth $200,000. Now it's worth, which means it has a negative $50,000 value. She's out $50,000. So two things happen here. Again, it could be a house. In this case, it doesn't matter. Any property outside of an IRA, any property, the same rule is going to apply. If she were to sell this, she will have a $50,000 long-term capital loss. That should be a C. And she can carry forward that $50,000 of loss to offset further gains. All right, so just keep that in mind. If Sharon sells this property with a $50,000 loss, she has $50,000 now as an asset in a long-term capital loss carry forward. LT capital loss carry forward, and you'll see that on your schedule is it D? I'm drawing a blank, but you'll see it on, I think it's Schedule D. Yeah, Schedule D will be your capital loss carry forward. It'll show you right there. How much of a capital loss carry forwards do you have? So what happens here, let's just say she sold Apple stock because she was big on Apple, and she sold it for a $50,000 gain. Well, she will not pay any capital gain on the Apple stock because she can use this long-term capital loss carry forward to offset the stock. So if she sells the stock for a $50,000 gain today, she'll use this $50,000 loss to offset it. There's no, so even Steven, no capital gain due whatsoever. Let's say she has a $25,000 gain in Apple. She can sell the Apple stock, not pay any taxes in that case because she still has $50,000 of losses. So she'll use half of those losses, that's why it is considered an asset, to offset the $25,000 capital gain that she has with Apple. And then she can take $3,000 off her income. So if she had $100,000 of income, she's only going to be taxed at $97,000 because you can take $3,000 a year each and every year until the remaining amount of your capital loss is exhausted. So I don't want to go too deep in that because it's important to understand, but because there's a second part of this I want to share with you. So remember, if she has a loss, all right, so bust out my PVC pipe, bought it 2007, $250. 2018, it's worth $200,000. If she sells this, she has a $50,000 loss in which she can do one of two things. She could use the $50,000 to offset other gains she has, or she can use $3,000 a year in which to offset $3,000 a year of income. And she can do that each and every year until this is exhausted. Critically important to understand. But let's keep going, because now, just like we did before with the date of death, what happens if she dies? And this is what her question was to me, which is what prompted me to do this video. Date of death is 2018. All right, so now Janie inherits this property for $200,000. All right, so there is no capital gain because it's not, there was a capital loss, but there is no capital gain. But guess what? Janie does not get to use any of that capital loss as her write-off. She doesn't get it at all. Now, she won't pay tax on that $200,000, but there's a net loss as a capital loss that does not pass on to your heirs. So that is a wasted asset. I cannot stress this enough. Capital losses do not transfer at your death. They stop right there. Thus, you've wasted the asset. If you die with a capital loss, you've paid too much in taxes. You paid too much in taxes because when Janie inherits this, this will now be her basis, $200,000. And that's critically important. That $50,000 loss is just gone. So you got to remember this. When you inherit a property, you're inheriting the basis for yourself from the date of death valuation. That basis could be above or it could be below the initial purchase price. It doesn't matter. That is what your basis is going forward. So now Janie's got this $200,000 basis. Let's say later on it grows to $250,000. Now she's got a $50,000 capital gain. Now she sells that for a $50,000 gain. She pays tax on that, even though her mom bought it for $250,000. Doesn't matter. The step up in basis is just a transfer of your basis. You get the basis, the date of death valuation of the price of that security or that real estate or the property, whatever it is, at the date of death for the person who left it to you. That means that $50,000 is wiped off the mat, and also can be wiped off the mat from a gain too. It doesn't matter. All that matters is date of death valuation. Janie gets it. If it's, she gets it as a loss or gain, doesn't matter. That is her basis. When she sells it, it is based on this for her own taxable records. Now, if she sold it for $150,000, she'll have a $50,000 loss for sure because she inherited at $200,000. That's essentially the same as her purchase price. Whatever she sells it for after, above or below $200,000 is what she can either write off as a capital loss, or she could use it as a capital gain where she has to pay 15% tax as long as she held it for over a year. But that's the difference in date of death valuations on a capital loss. So Sharon dies with this $50,000 loss. Janie inherits it. Janie has no capital loss to her that she can use whatsoever. None. It's gone. In this case, it's a house. I wouldn't recommend Sharon selling the house unnecessarily, unless she wants to get out of Dodge. That's fine. But you don't want to sell a house just to incur a capital loss. That doesn't make sense. But if it's a stock or bond or mutual fund or whatever, an investment portfolio of some sort, a condo that you have in Florida that's taking a loss, and you're just like, I don't think I'm ever going to get out from under this. Well, sell the doggone thing. Worst case scenario is you can use that $3,000 a year to offset $3,000 a year of income. Now, that might not be much, or might be, but certainly could be, especially when you're looking at messing with the tax codes for capital gains and Medicare premiums and Social Security tax and whatnot. Either way, though, if you die with this loss in the bank, it does not transfer. And that's just bad financial planning. All right. Capital loss don't carry forward. Capital step-up basis carries forward where you don't have to pay the tax on any gain. Capital loss, you don't get the write-off. So you don't get the tax, you don't get the deduction on the write-offs either. It's just the way the tax code works. So use it as effectively as you can. As always, if you like what you see, subscribe down below. Don't forget to comment, questions, thoughts. Go to the blog at heritagewealthplanning.com, and we'll see you next time. Thanks now.